Hello, hi there. Thank you for joining us. Thank you for joining yet another rendition of our Investment Insight series. Today's topic, a new era for emerging markets. Before we dive in, the fun stuff of any investment lunch, where we remind you that past performance is not indicative of future performance, or else I'll be presenting this from my private island. And also that markets may go up and down, and sometimes both, even before you finish your lunch, but that's why we're here today to help break it down for you. So, I am Angelina Lai. I'm the Chief Investment Officer for St. James's Place, Asia and Middle East, and I'm delighted to be joined by Jan De Bruijn, the Client Portfolio Manager. I'll also have a little introduction, so I'll invite you on stage in due time. But Jean is a Client Portfolio Manager and, most importantly, our EM expert, joining us from Robeco today. Before we dive in, though, just a little bit of introduction on St. James's Place. Hopefully many of you will already be very well aware. St. James's Place is the #1 UK wealth manager, which we're always very proud to say. And we have over 120, well, we have 120 billion pounds of assets under management as of the end of 2025. That equates to Sing dollar 375 billion. So it's quite a large amount, but what we're more proud of is the sheer number of our clients, 1 million clients globally, and actually really our retention, our very strong retention rate, which we believe to be a testament of our very personalized relationship-based advice that our advisors provide to you to maintain that relationship. As well as actually events like this where we break down our investment thinking. Talking about our investment thinking, how we think about investment at St. James's Place to manage your money. It's threefold. We start with top-down asset allocation, where we look for the best long-term assets, and this asset allocation through very deep technical analysis that we believe will bring our clients the best long-term outcome. From a bottom-up approach perspective, we then select the fund managers where we believe through a most scrutinizing and onerous process, and we believe absolutely a world-class process to come and manage these assets. And then finally, the portfolio construction, a really important component where we build these portfolios to fit your risk appetite, your preferences, to ensure that you have a robust portfolio through time. Because market moves, life changes, but it's really important for you to have the investment that matches your goals. So it's why we're joined, and I'm delighted that we're joined by Robeco today, who are one of the many exceptional fund managers that helped manage our assets around the world. Today's conversation, though, without further ado, is focused on the emerging markets, and I just want to start us off with this chart, which is really the race since the beginning of the century between EM and S&P 500, which many of you will know is the main index representing the US market. Many of you will have probably no doubt heard of the exceptionalism of the US. Well, actually what this chart shows is that the first decade did not start that way. EM, in fact, outperformed the US by annualized return on average of 15%. This includes the wobble that we saw during the global financial crisis. For the next 15 years, however, we have seen a rather long, what felt long and sustained outperform from a US, annualized 10%. But actually, since 2025, we saw that potentially shifting again because we saw a mid-20s outperformance from EM versus US. So, Jean, if I can invite you up to the stage. Right, so we saw in the chart just now that EM versus US race so far this century actually seems pretty head-to-head, and some may even argue that US may have come out somewhat in front. Now, being an EM expert, I assume you are on Team EM. So what are your key investment cases for the emerging markets?
Okay, this is all very dependent on really how the Iranian situation develops over the next few weeks. The base case is that we still very much see that the situation will come to an end in the next few weeks, hopefully at the beginning of April. But of course, if it goes on longer than that, then we can expect implications for the global economy, including EM as well. But when it comes to investment cases, the way we look at it is very much on well, we start off with country, and then when we're looking within country, we look very much at the kind of themes or investment themes that we like to invest in going forward. And these are very much long-term stories. They're not stories that, they're not about short-term export stories or globalization or anything like that. It's very much what are the structural trends that are happening within emerging markets at the moment and for the next 5-10 years. So some of the investment themes we're playing at the moment, well, one of course is technology. Now this is even pre-AI. Even before AI came along, we were very interested in how technology was evolving. That was very important for emerging markets because emerging markets have been able to adopt a lot of those technologies, basically leapfrog. And what I mean by leapfrogging is essentially because a lot of emerging countries had no legacy infrastructure, they were able to adopt new technologies very fast, faster than developed markets. So if you look at penetration rates for online shopping or fintech and so on, you'll see they're often much higher in emerging markets than they are for developed markets. Also, emerging markets have been able to innovate very cleverly a lot of the new technologies that we're seeing. You're seeing this across, whether you go to Brazil, whether you go to China or in India, we're seeing a lot of innovation to the point where a lot of Western companies are coming to the countries in the emerging markets and asking, how they've managed to innovate on the back of that. And of course, this is helping productivity and so on. At the same time, a lot of countries in EM, of course, have young demographics, and that means they're much quicker or much more able or willing to adopt new technologies as well. And then finally, of course, you've got Korea and Taiwan, who are the big players within the global IT supply chain. I often say to clients, no EM, no AI. And what that basically means is that if you can imagine AI as a destination, then you need a car to get to that destination, and that's the logic chips from TSMC. And they dominate with about an 85% market share. And then, of course, you need a road or a highway for that car to travel along, and that's the high bandwidth memory chips that you get with SK Hynix and Samsung in Korea. And they also have a 80% market share, which probably go up to 90% with the next generation. And so essentially without those companies, AI wouldn't function the way it does. So that's why, hence the no EM, no AI. And so that's a key investment case for us, or investment story going forward. There's various ways to play that. Obviously, the obvious ones are Korea and Taiwan, but you can also play indirectly through China in the AI stories, the internet-related names like Alibaba or Baidu or something like that. Another investment theme that's kind of come out from when we discuss emerging markets is the ongoing story of consumption. Now, this is not a new story, but it is ongoing. And it keeps expanding. Initially, it was very much about China and how the consumption class and middle income class was growing in China. But now it's expanded. You're seeing it in India, you're seeing it in Indonesia, you're seeing it in Brazil. And now you've got a 2 billion strong consumer class in emerging markets. And that actually has had big ramifications anyway, because it's one of the reasons why inter-regional trade has increased so much within emerging markets. And there's less going to the US, less exports going to developed markets. Anyway, so the consumer story is a very important one for us in very many different countries. But then there's also other things like the renewable story, which even though the US has kind of drawn back from that, it's still very important in places like India, and obviously China is the world's largest renewable market. And in fact, China being so involved in renewables has been very useful, of course, recently with the oil, because they've managed to diversify away from oil to a certain extent. So at the marginal level, they're kind of more protected than maybe other countries because of the fact that they've got other things like solar, like wind, like nuclear power and hydrogen and so on. So there's some of the investment cases we've been playing.
Fantastic, and I guess you mentioned that is your base case, notwithstanding how long this Middle East conflict might go on for. So can we maybe hear some of your potential scenarios on how the Middle East conflict might play out and how that might impact your EMA investment case, if you've got one. Particularly also, I find it quite interesting and really helpful that you're breaking down each of the potential effects to the countries and its markets. Many of us probably have heard of the impact on India and Japan in particular, where are heavily oil reliant, and therefore the closure of the Hormuz Strait are causing some big impacts. But you mentioned India earlier around the consumption story. Yeah, we might see the market still playing catch up a little bit. But what are some of Robeco and your thoughts?
Yeah, so you can imagine we've been talking about that a lot recently. India is actually a bit of a double whammy, unfortunately, at the moment, in the sense of obviously 40% of their oil needs comes through the Straits of Hormuz. And so even though the US has given an exemption temporarily, that they can access Russian oil, that's only to the 4th of April. And in any case, the Chinese also want that oil. And so, that they're competing there. Traders also know that India needs that oil, so they've, instead of getting the oil at a $13 discount previously, it's now a $4 or $5 premium. And at the same time, Russia, even if it wanted to, hasn't got the infrastructure in place at the roads or the pipelines to be able to, the ports and the pipelines to actually pivot towards China and India. So that's one whammy. The second whammy for India is the fact that they obviously have about 9 million expats living in the Gulf states. And that raises about 50 billion or so in remittances every year. And so clearly, if this carries on and they start coming back to India, then India loses that money, and the current account deficit can potentially worsen as well. For China, it's slightly different. Initially, it seems really bad for China as well, in terms of they get 80% of their oil coming that way. Yeah, so what China's been doing for the last few quarters is building up its capacity or its kind of storage of oil. And it's actually got about 3 months of oil in capacity or in storage at the moment. So it gives them a little bit of a buffer. As I said, they've also diversified away a little bit at the margin at least, so that helps a little bit. And of course, ultimately, they can go back to coal, which of course is not very renewable, but in the short term allows them, gives them a bit of leeway as well. So China's probably a little bit better protected than others.
And of course, I think that there's also the pivot towards more green type of technology from China, which we think also might have helped some of China's or less dependency on the Hormuz Strait.
Absolutely.
You mentioned technology and AI, really, really interesting, and you mentioned quite a lot around what we call the AI builders. And I wouldn't mind staying on China for a bit, but also happy to go to Korea and Taiwan, of course, which does seem to be feel like has been the hub of innovation. Our house via SJP for this year's key investment theme is the AI. AI will still continue to be a key investment theme. You probably all have experienced the various different AI bots, with Claude being the latest addition to the race, and probably experienced various benefits to it, but also along with it, some of the volatility we have seen in the tech industries. What we believe, given the high capex uncertainties with the AI builders, we actually think that while we believe the investment case, we actually think that the companies that are more adopting AI effectively, thereby increasing their productivity or reducing their costs, are more likely to come out as winners over the long term. Because they don't quite have that high capex expenditure. And we think China actually does that quite well. So it's certainly a market that we are looking quite actively at and remain very interesting. Obviously, notwithstanding all of the headwinds potentially economically and structurally. So any thoughts on that from your perspective?
Yeah, so in terms of AI, it's an interesting one in the sense of the capex that you mentioned. So obviously, Korea and Taiwan are also spending lots of capex, but I think it's slightly different for them than, for example, like NVIDIA, because NVIDIA is obviously the final demand. At the moment, they're the only player or key player, but obviously there will be other players that come into this market, and that's actually good news for Korea and Taiwan, and China, I suppose, as well, ultimately, because obviously the more customers you have or the more clients you have, obviously the more you the less of a reliance you have on one particular client in terms of pricing and so on. At the same time, because they are the dominant players in the chips they manufacture, and as AI gets more complex, you constantly have to go to next generation nodes, and really they're the only companies that can do that. They are in a very strong position regardless of which way the end demand for AI goes. When it comes to China, obviously after DeepSeek was announced to the world, and the Chinese government realized that actually they could compete with the US on AI, the Chinese government kind of pivoted it somewhat and started investing, billions into that industry. But to get direct exposure is quite difficult at the moment. There are some hardware companies or some chip companies, but from our point of view, we prefer the Koreans or the Taiwanese, particularly the Koreans for valuation purposes. And therefore, we tend to play indirectly, as I mentioned earlier, with the kind of the internet names, or even more directly, let's say Trip.com, which has been using AI for its travel online business.
Thank you. That's really helpful, and of course, so thank you for breaking down some of the things. So let's just bring it back to scenario a little bit, because a lot of us are all in scenario land at the moment with this conflict potentially going on for longer than the market had initially either expected or hoped for. Now, one of the scenarios, and I remember when we talked in January, of course, before all of this happened, one of your strong investment case for emerging market was in fact that the weakening US dollars. Now, with the potential Middle East conflict, which may raise inflation, at least in the shorter term, how might that play out in the rate trajectory, and how might that impact your investment thesis in either the countries, markets, or in different sectors?
Yeah, good question. Let me put a diagram up. Yeah, so the US dollar was just one factor that really made EM outperform last year. There were 5 factors that we believe all happened at the same time, which was quite unusual. A confluence of factors, as we called it at the time. So you did indeed have a weaker US dollar last year, and that's traditionally always been good news for emerging markets.
Why is that?
We think less so now, but in the past, obviously, a lot of countries had a lot of debt, and a lot of that debt was denominated in US dollar. At the same time, they also traded a lot with the US, so a lot of trade was done in US dollars. And so hence, any strengthening of the dollar was not a good thing for emerging markets in terms of the debt positioning and so on. We think it's less now partly because we think interregional trade has become such a much more important driver of trade growth. The exports that go to the US from the EM have fallen from about 20% to about 14-15% over the last 25 years, while trade has gone up by 500% within EM. And also their debt position's much better than it was 15-20 years ago, and the amount of debt that is US denominated as a percentage has gone down a lot as well. So we actually think there isn't such a big correlation anymore, but nevertheless investors still find it very important, and therefore we keep looking at it because it does affect investor sentiment. But the other factors were that really came together was the fact that earnings was expected to be strong for a second year in a row last year, and it was. Macro stayed very resilient last year in the emerging markets, even though we had the so-called tariff impact last year. Didn't really impact earnings, nor did it impact countries. There was a reason why it didn't impact earnings, because if you look at listed exposure to US end demand, in a lot of emerging market countries, it's actually very low. So if you look at listed exposure for China, for instance, it's less than 6%. Because if you think about it, most of the big companies that are listed are the internet companies and the banks, and they all get their revenues mainly from domestic market. And it's the same with India. It also has a very low percentage of exposure to US demand because of the fact that most of the companies sell to a very large domestic market. So earnings were good, macro was good, people were underweight EM, and though they tried to pivot towards EM towards the end of the year, they were certainly very underweight at the start. And then finally, of course, we also had the fact that the valuation was cheap as always because of 10 years or 15 years of underperformance. And so our case has been for this year, getting back to what you've asked me, roundabout way, we think most of those factors are still in place this year, and depending, of course, on the Iranian situation. So the US dollar, of course, has strengthened recently as a belief that that's going back into a safe haven. We would question whether that is such a safe haven nowadays of the US, but anyway, that's what's happened. But of course, if the Iranian situation comes to an end in April, early April, then we would expect the US dollar to perhaps weaken again, and certainly the other factors that we have up there will remain in place. So earnings are expected to be up for a third year in a row, which is very unusual for emerging markets and shows how the quality of earnings has changed in emerging markets. We expect the valuation to remain very cheap because it's still at a 35% discount even after last year's rally. And at the same time, we expect growth to remain pretty relative to DM in a much better position in terms of inflation, in terms of economic growth, and so on.
What about on the sector perspective?
Yeah, sectors are hard one for us because we don't tend to look at sectors. It's an output for us. The way we do our investment process, it's very much about country and stock, and then the sector is the result of that. But obviously, our sectors do reflect what we're thinking. So, I mean, what I can say is that the consumer sector, this consumer discretionary sector, remains very important for us. The materials or resource sector has become increasingly important for us. Technology obviously remains a very key sector for us. But ones where we're less confident on would be, for example, the consumer staples sector, where we find it very commoditized. And in any case, if you do expect inflation to go up a little bit, that's not a good sector to be in any case.
That's really helpful. To what extent should investors consider the Middle East and Africa? Now, of course, Middle East is actually it's at less than 1% of MSCI equity and only 7 to 8% even in the MSCI emerging market. So I assume you may have some exposure to the Middle East market. Any thoughts on those?
Well, yeah. So we've been underweight Middle East even before this happened. The only country that we've liked is UAE. We're probably having to reconsider that story even if things come to an early end. The reason we like UAE is because it was a much more diversified economy than Saudi. It's managed to get away from the oil and gas reliance, which used to be 75% of GDP, which it's down now less than 50% GDP, and they've gone into other things like renewables and infrastructure projects and so on. And we like the fact that tourism was strong, the property sector was strong, and of course it had valuations very, very attractive. And so therefore that was a very obvious one for us to invest in. I think what's changed, even if things come to an end in the next few weeks, is that I think that safe haven kind of idea of those countries being kind of relatively safe to live in and so on has been punctured. I'm not saying it's completely gone or that people won't want to live there anymore, but it's definitely there will be a higher risk premium put onto those countries because clearly they are at risk at times. Even if it's only rarely. So I think there is a higher risk premium to put on there, and tourism may be a bit weaker for a little while as a result. But if you go outside the Middle East and go into Africa, we do like South Africa.
For mining?
Not just mining. Mining is obviously a very important part, but that's actually, they make a lot of their revenues outside South Africa by selling outside. So it's a good story from a global resource point of view. But actually, South Africa itself is quite an interesting story now, ever since the coalition government came in, mainly because it's a much more reform, pro-business kind of government. And so they've been putting in place a lot of new policies to try and put more investment into the economy, which is something that's been very woeful in South Africa for a long time. They've also put in a lot of money into improving the infrastructure, in particular the electricity, where they've had used to have lots of brownouts almost every day at one point, and I think it's now only once a month. So they've really made a big change there. They've tried to get consumer consumption to go up. So what we're seeing is a very gradual lifting up of the economic growth. It's not a very significant, like from 2% to 6%, but it is like going up to 3%. And if they continue on this path, then it's looking very positive from a domestic point of view.
That's really interesting, and thank you, particularly on the Saudi story. I sort of just something that I picked up and I wanted to expand on a little bit. We talked a little bit, we touched a little bit also earlier on China and India, where it's really that disconnect between the economy, where the impact on the economy from the war, from all the headwinds, etc., versus the market. And so that's a really interesting one. Saudi obviously economically has quite a high reliance on oil still. It's obviously trying desperately, well, not desperately, but it's trying to expand. It's trying to follow the UAE example, expanding into other infrastructure type projects. But still, actually, if you look at the market, I think something like 30 to 40% is still in Aramco, which is highly concentrated as well from an investment perspective. So certainly when we look at asset allocation, that's something that we take into a lot of consideration, which is the level of concentration. I will pause again and see if there are any questions. Great, over there.
What's your pecking order of various regions or countries?
Yeah.
Your favorite ones?
Yeah, so we're overweight LATAM, and then we're overweight Eastern Europe, and then we're basically underweight everywhere else regionally. In terms of countries, our biggest overweight is still Korea, regardless of the volatile movements we've seen. Because we think the the reason why we hold Korea is partly tech, but it's also the corporate governance story, which is improving the valuations, and that's not going to be changed by what's happening in Iran. So we continue to invest there. We also like Brazil in Latin America. We like Mexico, so they're kind of the two countries we like there. For different reasons. Brazil's partly the oil, Petrobras, which is a better way to play in our view than Aramco for valuation reasons. But there's also, we're expecting interest rates to come down in Brazil because real rates have been one of the highest in the world at close to 10%. And the central bank's been quite dovish recently in terms of the next movement down. Mexico is more about the China Plus One story and growth. So China Plus One, by the way, is just basically companies diversifying away from China and moving into countries like Vietnam, Indonesia, Mexico, and so on. So Mexico is a beneficiary of that, particularly with its closeness to the US. At the same time, growth has been quite good as well, and valuations are being attractive. There's also a story developing whereby Mexico's always had a very low, there's a high percentage of people who don't have access to financial services. And so the introduction of fintech and so on has really improved or decreased that number, and more people are having access for the first time to financial services. So there's a few ways to play that in Mexico. We used to play that in Brazil, but that's kind of come to an end from a valuation point of view. And then within Asia, we're overweight Korea and Indonesia. So Indonesia is been disappointing, I'll be honest. Last year was very much about politics. This year it's very much about worries about whether it goes into the frontier market. We think for now they won't be put into the frontier market because they've announced quite a few policies to try and address some of the concerns the MSCI had, particularly about the free float. But I think they will still be on notice with the MSCI, and they'll want to see whether these policies are actually put into place in practice. But the unfortunate thing with Indonesia, politically wise, it's the government is sliding backwards a little bit towards how Indonesia was in the past a little bit. Some corporate governance issues and so on within the government. But at the same time, the growth rates are still very attractive. It has a great demographic story with a young population, so it's a very big beneficiary of the China Plus One strategy. It's also the world's largest nickel producer, which is great for electrical vehicle battery manufacturing, which is still growing very strongly. So, from a macro top-down point of view and stock picking point of view, it looks very attractive, especially now with the valuations. But from a political point of view, there are concerns. And then within I've mentioned South Africa, so not really.
You mentioned
Eastern Europe.
Oh yeah, sorry. Yeah, well, thank you. Yeah, so we like Hungary and Poland, but Hungary is more to do with the fact that there's a stock there that we like, which plays into the pharmaceutical story in the US. So it's not really a Hungary story. But Poland is partly to do with it's mainly to do with the growth story. It's been growing pretty fast within an EU context. It's also a big beneficiary of defence spending. It has a very large defence industry because it's been spending 5 to 6% of its GDP on defence for a long time. But we also have a company there which is called KGHM, which is actually a mining company. It has a copper mine in Chile. So that's actually a resource story rather than a Polish story.
Thank you.
On the flip side, your least favorite.
Yeah. Well, our largest underweight is India, but that's a reverse story to China for us. So, China's very much not a very exciting top-down, but quite interesting stock still. But India is a very interesting macro story, certainly long-term at least, longer term, but stock picking or stock selection for us not very attractive. So long-term, India has been doing all the right things in the past few years in terms of reforming its economy, cutting the red tape, building up its infrastructure very aggressively. So this is a country that we kind of think the next decade is India's decade in terms of growth. In the short term, it's stumbling. Growth is slowing down. The middle income part is spending less. I think there's a feeling within India that maybe all the wealth or the 8-9% that we've been seeing the last few years isn't trickling down to everyone. But on the good side, the inflation's been quite sticky in the sense of not going up too much, which for India is quite unusual. But they also had bad luck with the monsoons, so that affected GDP as well. The budget is trying to get that balance between growth and keeping the fiscal deficit kind of at an acceptable percentage. So short term, there's a few term issues, but in terms of the valuation, even though it underperformed last year, the premium to the MSCI EM index is still over 50%, because earnings also declined last year. So actually, there was no real impact on the premium. And so the way we look at stocks, which is basically we're looking for companies that have an attractive upside from a DCF point of view, and have mispriced earnings upside or unexpected growth potential in earnings. That's really hard to find in India, so we are underweight. And the other largest underweight is Saudi Arabia, where in most of our funds we have nothing.
Thank you for sharing your insights. That's really interesting. I wanted to go back to what you said earlier about no EM, no AI. And I think that's very true for sure. I mean, we've heard this story for quite some time now, especially given the outperformance that we've seen from Korea. But when we talk about AI and EM, I think the story really stalls at, Samsung, SK Hynix, and TSMC, right? I mean, okay, China AI story is one to take note of, but it's a very domestic story, and It's not like Chinese models can be adopted worldwide, right? So where else do you see that AI or tech story? Like India, for example, seems to be really a big laggard on the AI story, even though they have a huge tech services sector. Everywhere else, when Japan maybe could be a contender, especially given their historic success with robotics and automation. But to differ from what Angelina said earlier, I think the automation phase of AI is the one that is the most difficult to invest in. Given the disruption fears as well, and one company obviously adopts it somewhere, and the other one just does a better job of doing it. So I think the adoption cycle would be far longer, and the safer areas are potentially in the data centers or the power and the cooling and the utility side. But again, I mean, in EM, I don't see any of those beyond the two Korean and one Taiwanese names, and then the concentration risk also in Korea and in Taiwan is pretty significant. So how else do you get an AI exposure in EM?
Yeah, it is very difficult, to be honest. A lot of the AI story is more about productivity gains and how they can use AI to do that, like we're doing in the West, but I think the gap in EM is bigger, so there's more potential for upside. And also a lot of the companies that are adopting AI and being very clever with it are very small and not listed at the moment. But one indirect way would be, for example, the packaging companies that are based in, for example, Malaysia, but also in the there's actually also in the Middle East. They've become hyperscalers as well because they've become very skilled at being able to package the AI or the chips that are needed for AI. So that's one other way to play it as well, because they are listed, particularly the Malaysian ones are listed as well. But you're right. Beyond that, it becomes a struggle to actually think of listed names, other than, for example, companies that are using AI successfully. For example, fintech companies, which is mainly then Latin America, to be honest, a little bit in Middle East again. And then you've got, I suppose, like I mentioned earlier, Trip.com, that are using AI again to improve the productivity or improve their platform and so on. But I suppose the other one that maybe you shouldn't forget about is in India, which is basically the internet service companies, like Infosys and Tata Consultancy, which, sorry? No, well, this is the argument that our analyst is now making is that they were initially sold off because the idea was that companies would think, well, we can just do what they do, installing AI. But actually doing that's not that easy, right? It's actually very complex and complicated. You can't just putting AI in your operations at work and then suddenly it does what these companies do. So these companies are now also offering AI integrated into their offerings, making them much more efficient and at a cheaper price. And therefore, our analyst feels actually that these companies are now undervalued as a result, because that's the kind of products that clients will want, because they'll find that they can't do it themselves. So.
And I guess I had this as one of the submitted questions, but I sort of will offer one answer to that. So the question says, what basically has the Middle East conflict created in terms of opportunities, right? And one of the things that we are actually seeing, so quite interesting sort of story about India, and what I sort of took away from your earlier discussion was really that you like India. I think we also like India. We like the India story. We think there's a lot of potential, good fundamentals, good economic, etc. But we believe it's primarily just being a bit too pricey, and therefore there's just relatively much more attractive opportunities elsewhere. However, this conflict is currently bringing some of these prices down, and same we've talked about quite a lot within sort of other talks and discussions. My CIO letters around the US being too expensive, and fundamentally that creates that both the concentration risk from the AI as well as just sort of the valuation from not being attractive. But actually what this conflict is sort of readdressing some of that, because we're seeing that band essentially coming, the gap coming back a little bit. So that is creating opportunities for sure. So are you seeing that potentially happening? Well, it sounds like you still haven't seen any of the India companies come into within the technical range that you're looking for, but potentially, is that potential for opportunities, and are there any other opportunities you've taken since the conflict?
Yeah, so earnings are still quite weak in India, so even with India coming down, it's not made that much difference to valuations, to be honest. But our view is more that the premium will start to come down, or continue to come down, mainly more because, according to some forecasts out there by different sell-side research, there's about $5 billion of IPOs coming onto the Indian market in the next couple of years. That's where we think there's going to be more opportunities, and that will bring down the valuation because of the sheer amount of new equity issuance that's coming on to the market. So that's really more the way we look at it. So.
Great, thank you. One more question over there.
Hi, very insightful, thank you. So just a bit of background, I have a doctorate in AI and I implement AI at large institutions. That is what I do for my living. What I'm really afraid of is the AI bubble, which might be much bigger than the subprime crisis. What's your strategy to protect on the downside of the AI bubble?
That wasn't me. Yeah, well, you're going to be far more knowledgeable than me on the actual AI industry, but I mean, we look at it from an investment point of view. And we do think that if you look at the valuations, particularly for the Korean companies, they are so ridiculously cheap still. There's no bubble there. The bubble is mainly more, we think, in companies like Nvidia and the US kind of companies. As I mentioned to you earlier, the more players that enter this market, the better it is for those chip suppliers. So both SK Hynix and Samsung are trading at below 10 times PE, even though they've had ridiculous growth rate performance last 12, 13 months until recently. And yet they've got earnings growth of over 15-20% for the next couple of years. So from our point of view, that we don't see any bubble, and that, in fact, if anything, there's a bubble maybe in the US, but then we think there might be rotation, which I think we were starting to see actually at the start of this year with Samsung and SK, that people rotate into those players to continue to play the AI story. Because the AI story isn't going to go away. It's only going to get increasingly sophisticated and complex, in our view. I mean, you'll know better than me. But so it's only going to be a bubble in the sense of at the end demand, perhaps. But for the suppliers, it will just continue to grow. So.
Okay. One last question. Is that okay?
Thank you. Which one or two of your views or positions would have to be seriously looked at again if you were to assume that this conflict in Iran goes on for a year? More.
Yeah, well, if the conflict goes on for a year, we're going to have a global recession. Inflation rates will go much higher, which will affect all countries, whether it's EM or DM. And so you really want to be in those you want to be in those equities that have pricing power or benefit from rising pricing. So I suppose you want to be in commodity names. You want to be in the high tech names in Asia because they have pricing power because no one else can supply the chips. You don't want to be in consumer staples. And you don't want to be in anything where you don't have pricing power, basically. So, to be honest, we haven't considered that far because we're not thinking that's going to happen. In the sense of that, if it's a year, that's going back to 2008 global kind of financial crisis levels. I don't think anything is particularly safe then in that case. I think everything will be sold off within EM in that sense.
I assume that's primarily due to the continued closure of Hormuz Strait assumption.
Yeah, absolutely. Yeah.
Okay, thank you very much. Sorry, we've just had the last question, but do come and find us afterwards. So actually, before I go to the final socials, etc., I will just ask you one last question, sorry, but it's a very quick question. 2050, EM or US? Very good.
EM any day.
Very good, thank you so much, Jan. I will just take the clicker, if that's okay. Actually, we have... Okay, very good. We're finished on this. I think we will send around the survey afterwards, and we will have also the links to our socials. Please do like it, do share your thoughts on the event, and do come and talk to us afterwards to share any thoughts. Thank you so much for joining us. Thank you.